For so many of us, owning a home is more than just having a roof over our heads. It represents a piece of the American dream, a symbol of stability and success. It's the place where we'll raise our families, celebrate holidays, create memories that last a lifetime. This desire is, honestly, deeply woven into the fabric of our culture. We often see homeownership as a major life milestone, a rite of passage into adulthood and financial security. It provides a sense of belonging to a community, a place where you can plant roots, watch your children grow up with the kids next door. The feeling of unlocking your own front door for the first time is a powerful one. This dream is also about building wealth for your family. When you pay rent to a landlord, that money is gone forever. But when you make a mortgage payment, a portion of it goes toward owning your property outright. This is called building equity. Over many years, as you pay down your loan and as the value of your home potentially increases, you're creating a significant financial asset. Think about the security that comes with owning your own space. You don't have to worry about a landlord suddenly deciding to sell the property or raising your rent to a level you can no longer afford. You have the freedom to paint the walls any color you like, to plant a garden in the backyard, or to make changes that suit your family's needs. This control over your living environment provides a deep sense of comfort and peace of mind. It's a sanctuary from the uncertainties of the world, a personal haven that is truly yours and yours alone. That is why the policies that affect home buying are so incredibly important. They don't just impact numbers on a spreadsheet, they touch the very core of our aspirations and our ability to build a better life. The rules set by the government, the banks, and other financial institutions can either open the door to this dream or, honestly, slam it shut for millions of hardworking Americans. Understanding how these systems work is the first step toward navigating the path to homeownership and making that deeply personal dream a tangible reality for you and your loved ones. Let's break down the biggest word in home buying: mortgage. At its heart, a mortgage is simply a special type of loan used to buy a house or other type of real estate. Most people don't have hundreds of thousands of dollars in cash just sitting in a savings account. So, a bank, a credit union, agrees to lend them the money needed to purchase the property. In return for this very large loan, the borrower promises to pay the money back over a set period of time, which is often 15 years or 30 years. Think of it like buying a very expensive item on an installment plan. You get to use the item, in this case the house, right away. But you make regular monthly payments until the loan is fully paid off. Each payment you make is split into two main parts. One part is the principal, which is the actual money you borrowed. The other part is the interest, which is the fee the bank charges you for letting you use their money. The interest is how the lender makes a profit. Over the course of the loan, you will end up paying back much more than the original amount you borrowed. The house itself plays a very important role in this arrangement. It acts as collateral for the loan. This is, a fancy way of saying that if you stop making your payments for any reason, the lender has the legal right to take possession of your home. This process is called foreclosure. It's the bank's safety net, ensuring they don't lose all their money if a borrower defaults on the loan. This security is what makes lenders comfortable with giving out such large sums of money for such a long period of time. It's a serious commitment with significant consequences. So, when you hear people talking about getting a mortgage, they're talking about entering into a long-term financial contract. They are borrowing a massive amount of money and using their new home as the guarantee. This agreement allows them to achieve the dream of homeownership much sooner than if they had to save up the entire purchase price in cash. It is the most common financial tool that turns renters into homeowners, making it a cornerstone of the housing market and the broader economy. It is a powerful yet complex financial product. You might be surprised to learn just how involved the U.S. government is in the mortgage process. Its role isn't just to make rules, it actively helps people become homeowners. One of the biggest ways it does this is through government-sponsored enterprises, or GSEs. You may have heard their names: Fannie Mae, Freddie Mac. These are not regular banks. Their job is to buy mortgages from the lenders who first gave them to home buyers. This frees up the lenders' money, allowing them to turn around and offer more loans to more people. It keeps the whole system flowing smoothly. Another direct way the government helps is by insuring or guaranteeing certain types of loans, making them less risky for banks. The Federal Housing Administration, or FHA, is a perfect example. An FHA loan is a mortgage insured by the government. These loans are incredibly popular with first-time homebuyers because they often allow for a lower down payment and are available to people with less than perfect credit scores. If a borrower with an FHA loan fails to make their payments, the government steps in to cover the lender's losses. This encouragement makes banks much more willing to lend to buyers they might otherwise consider too risky. The government also offers special programs for specific groups of people. The Department of Veterans Affairs, or VA, offers a fantastic benefit for service members, veterans, and eligible surviving spouses. VA loans often require no down payment at all, which is a huge hurdle removed for those who have served our country. Similarly, the Department of Agriculture, or USDA, offers loans for homes in certain rural and suburban areas. These programs are designed to promote homeownership in parts of the country that might otherwise be overlooked, helping to build and sustain those communities. All these programs work together to make homeownership more accessible for a wider range of Americans. By buying loans, insuring them against default, and offering specialized programs, the government creates a more stable and active housing market. It's like a safety net stretched out underneath the tightrope of mortgage lending. This support gives banks the confidence to lend and gives many families the opportunity they need to purchase their first home, strengthening both individual households and the national economy as a whole. Without this helping hand, far fewer people would be able to achieve their dream. Recently, the gears of government have been turning, and some important changes are being put into place. These new actions are coming from two very powerful players, the Department of Justice and the Federal Reserve. These are not just small tweaks. They represent a significant shift in how the government looks at fairness and risk in the mortgage industry. They're really designed to address long-standing issues and make sure the system works for everyone, not just for some. Even though these changes are happening quietly behind the scenes, their effects are going to be felt for years to come. The Department of Justice, which acts as the nation's top lawyer, has sharpened its focus on fair lending practices. It has launched new initiatives aimed at combating modern-day redlining. Now, redlining is an illegal practice where banks refuse to lend money to people in certain neighborhoods, often based on racial or ethnic makeup. The Department of Justice is now using advanced data analysis to really scrutinize lending patterns across the country. If they find that a bank is consistently avoiding lending in minority communities or is unfairly denying loans to qualified applicants of color, they're prepared to take strong legal action, including imposing massive fines. Meanwhile, the Federal Reserve, which supervises many of the nation's banks, is updating the rules for how banks are evaluated. One of the key regulations is the Community Reinvestment Act, or CRA. This law requires banks to meet the credit needs of the entire community where they operate, including low and moderate income neighborhoods. The Fed is in the process of modernizing the CRA to account for the rise of online banking. In the past, the rules were based on physical bank branches, but now the Fed wants to make sure that banks are also serving communities where they take deposits online, even if they don't have a building there. These actions are happening together and are meant to send a clear message to the entire banking industry. Fairness and equal access are no longer optional. The Department of Justice is the stick, ready to punish discriminatory behavior. The Fed is updating the rule book, changing how banks are graded on their community involvement. Both are pushing for a more inclusive system, where a person's chances of getting a home loan depend on their financial qualifications, not on their skin color or the zip code they live in. This two-pronged approach intends to reshape the landscape of mortgage lending from the ground up. So what does all this mean? For you, the person trying to buy a home, these changes could cut both ways, potentially making it easier for some and, in certain ways, a bit more complicated for others. On the one hand, the government's intense focus on fair lending could open doors that were previously closed. If you're a qualified borrower living in a neighborhood that has historically been underserved by banks, these new rules might mean you finally see more lending options and a fairer shot at getting approved for a loan. Banks will likely feel the pressure to expand their lending horizons, to get a good score on their updated CRA exams, and to avoid the watchful eye of the Department of Justice. They're going to have a powerful incentive to lend more money to minority borrowers and in lower-income communities. They could develop new mortgage products, open branches in new areas, or partner with community groups. For a family that has always been told no, this shift could be the very thing that turns their dream of homeownership into a reality. However, there's another side to this coin. As banks face more scrutiny and potential penalties, they might become more cautious in their overall lending practices. To make sure every single loan is perfect and can withstand government review, they might tighten up documentation requirements for everyone. This could mean more paperwork, more questions, and a longer, more drawn-out approval process for all applicants. You might find that the bank asks for extra pay stubs, more detailed explanations for every deposit in your account, additional letters of explanation for any blips in your credit history. In essence, the path to a mortgage might become more equitable, but it could also become more rigorous. Banks will be walking a tightrope. They need to lend more in certain communities to satisfy the government, but they also want to avoid making bad loans that could lead to foreclosures. For the average home buyer, this means you need to be more prepared than ever. Having your financial documents in perfect order, understanding your credit report, and being patient with the process will be key to successfully navigating this new and evolving lending environment. To understand the real-world impact, let's imagine two different scenarios. First, meet the Garcia family. They're a hard-working couple. They have steady jobs, and a decent, but not perfect, credit score. For years they've dreamed of buying a home in their city neighborhood, but they've been turned down for a mortgage twice. Lenders told them their debt-to-income ratio was a little too high. Their neighborhood is predominantly minority and has historically seen very little investment from big banks. It's a classic case of an underserved community, even if no one used the ugly word redlining. Under the new government pressures, a local bank is re-evaluating its community lending strategy. To boost its CRA rating and show the Department of Justice it's serious about fair lending, the bank launches a new home loan program specifically for first-time buyers in neighborhoods like the one where the Garcias live. This program might use more flexible underwriting criteria, considering things like a strong history of paying rent on time. The Garcias reapply through this new program. This time the loan officer works with them and they're approved. For them, the government's new focus was the key that unlocked the door to homeownership. Now let's consider a different situation with the Baker family. They have a high credit score, a solid income, and are looking to buy a home in a well-established suburb. In the past, getting a loan for them would have been a quick and straightforward process. However, their bank is now operating under the microscope of the new regulations. The bank's internal compliance department has created a new exhaustive checklist for every single mortgage application, to ensure there is no hint of discrimination, and that every file is flawless in case of a government audit. As a result, the Baker's loan application process drags on for weeks longer than expected. The lender asks for repeated updates of bank statements and painstakingly verifies every detail of their employment. While they're ultimately approved for their loan, the process is far more stressful and invasive than they had anticipated. For the Bakers, the ripple effect of the new policies wasn't a yes or no answer, but a significant increase in the hassle and anxiety of the home buying journey. Looking toward the future, these actions by the Department of Justice and the Federal Reserve are poised to reshape the landscape of homeownership in America for years to come. The immediate goal is clear: to create a mortgage market that is more inclusive and equitable. If these policies work as intended, we could see a gradual but meaningful increase in homeownership rates among minority groups and in communities that have long been left behind. This could help to narrow the persistent racial wealth gap, as more families gain the opportunity to build equity through their homes. However, the longer-term effects will depend on how the banking industry responds. Will banks truly embrace the spirit of these rules and find innovative, safe ways to lend to a broader population? Or will they react with excessive caution, tightening their standards so much that it makes borrowing harder for everyone? The best-case scenario is a future where technology and better data analysis allow lenders to more accurately assess risk, making fair and profitable loans without relying on old, biased assumptions. This could lead to a more dynamic and resilient housing market for all. We as consumers and citizens also have a role to play in this future. It's more important than ever to be educated about our finances. This means actively working to improve our credit, saving diligently for a down payment, keeping meticulous financial records. Understanding the rules of the game allows us to be our own best advocates. Community organizations will also be crucial, helping to educate potential homebuyers and connecting them with the new programs and opportunities that banks may be offering. An informed public is a powerful force for change. Ultimately, the American dream of homeownership is not a static concept. It evolves with our nation. These new policies represent a deliberate effort to bend the arc of our housing market toward justice and opportunity. The path forward might have some bumps, and the balance between promoting access and ensuring safety will always be delicate. But the conversation has been shifted in a fundamental way. The secret is out. The government is watching, and the expectation is that the doors to homeownership should be open to every qualified American, regardless of who they are or where they live.